I've watched people destroy their wealth in ways that break my heart. People who spent 40 years building something meaningful, who sacrificed and saved and did everything right, only to blow it all in their 60s because they made mistakes that were entirely preventable. I am going to tell you about the 5 mistakes that will destroy your wealth. If you are over 60, these aren't obscure technical errors. They're common patterns I've seen repeated hundreds of times over my 30-plus years managing money. And the tragedy is that every single one of them is avoidable if you know what to look for. Let me be clear about what is at stake here. When you are 25 and you make a financial mistake, you have decades to recover. Time is your friend. The market's long-term upward trend will bail you out eventually. But when you are 60 or 65 or 70, you don't have that luxury. A major mistake at this stage of life can mean the difference between a comfortable retirement and running out of money, between leaving something to your children and becoming a financial burden on them, between dignity and desperation. I made $7 billion in a single year by understanding risk and positioning correctly during the financial crisis. But I'll tell you something that might surprise you. Avoiding catastrophic mistakes has contributed more to my long-term success than any single brilliant trade. The math of compounding rewards consistency. One terrible year can wipe out a decade of good years. Understanding this asymmetry is fundamental to building and preserving wealth. So let me walk you through these 5 mistakes, explain why they're so destructive, and show you exactly how to avoid them. Mistake number 1 is chasing yield without understanding risk. This is the most common wealth destroyer I see among people over 60, and it is driven by a completely understandable desire. You want income, you need income, you've stopped working, or you are about to stop working, and you need your investments to generate cash flow to live on. So you look at your portfolio and you see that treasury bonds are paying 4%, and then you see some other investment paying 8%, or 10%, or 12%, and you think, why would I accept 4% when I can get 12%? That is 3 times the income. I'd be foolish not to take the higher yield. This thinking has destroyed more retiree portfolios than any market crash, because yield and risk are inextricably linked. When something pays a higher yield than comparable investments, there is always a reason. Always the market isn't giving away free money. If an investment yields 12% when treasuries yield 4%, that 8 percentage point difference is compensation for risk. Risk of default, risk of principal loss. Risk that the yield will be cut, risk that you won't get your money back. Let me give you specific examples of how this plays out. High yield bonds. Also called junk bonds. They're called junk for a reason. These are bonds from companies with weak finances, high debt loads, and meaningful probability of default. Yes, they yield more than investment-grade bonds, but in a recession, default rates spike. That 8% yield doesn't help you if the bond defaults and you lose 40 or 50% of your principal. I've seen retirees put half their portfolio into high-yield bond funds because they like the income. Then a recession hit, the fund dropped 30%, and several holdings defaulted. They lost years of income in a matter of months. The yield was an illusion. Master limited partnerships, or MLPs. These are energy investments that often pay very high distributions. 7, 8, 9% yields are common, but those distributions aren't guaranteed. When energy prices collapsed in 2014 and 2015, many MLPs cut their distributions dramatically. Some cut them to 0. The investors who bought for yield suddenly had neither yield nor principal. Non-traded REITs. These are real estate investments that aren't traded on public exchanges. They often advertise yields of 6 to 8%, but they're illiquid. You can't sell them when you want to. The valuations are opaque. The fees are enormous, often eating up 15 to 20% of your investment before you earn a penny. And when the real estate market turns, these investments can become worthless while you are locked in and unable to sell. Business development companies, or BDCs, these lend money to small and mid-sized businesses and pay out high dividends, 8, 9, 10% yields, but they're lending to risky borrowers. In a recession, defaults spike. The dividends get cut. The share prices collapse. What looked like a 10% yield becomes a 20% loss. I could go on. The pattern is always the same. Investors chase yield, they ignore the risks. And when those risks materialize, they suffer devastating losses that take years to recover from, if they recover at all. Here is how to avoid this mistake first. Accept that in the current environment, a sustainable yield on a diversified portfolio is probably 3 to 5%. If you are reaching for significantly more than that, you are taking risks. You may not understand second. Understand that yield is not return. Yield is just the income component. Total return includes both income and capital appreciation or depreciation. A bond paying 8% that loses 20% of its value gave you a negative 12% total return. Focus on total return, not just yield. Third, diversify your income sources. Don't put all your eggs in one high-yield basket. Own a mix of treasury bonds, investment, grade corporate bonds, dividend-paying stocks, and maybe a small allocation to higher yielding investments. The blended yield will be lower, but the risk will be much more manageable. Fourth, be especially skeptical of anything paying more than twice what treasuries pay. If treasuries yield 4% and something yields 10%, ask hard questions about why. The answer will reveal risks you need to understand before investing. Mistake number 2 is failing to adjust your strategy as you age. This mistake is almost the opposite of the first one. It is not about taking too much risk in search of yield. It is about taking too much risk because you haven't updated your approach from when you were younger. When you are 30 or 40, an aggressive portfolio makes sense. You have decades until retirement. You can ride out bear markets. Time is on your side. A portfolio of 80 or 90% stocks is appropriate because the long-term growth potential outweighs the short-term volatility. But that logic doesn't apply when you are over 60. Your time horizon has shortened. You may be drawing on your portfolio for living expenses. You can't afford to wait 10 years for the market to recover from a crash. The strategy that was right at 40 is wrong at 65. I've seen people in their late 60s with 90% of their portfolio in stocks because that is what they had in their 40s and they never changed it. They rode the bull market up and felt like geniuses. Then the market dropped 30 or 40% and they panicked. Some sold at the bottom, locking in catastrophic losses. Others held on but had to reduce their withdrawals, crimping their lifestyle. Either way, they suffered needlessly because they didn't adjust their strategy. The mathematics of sequence of returns risk make this especially dangerous. If you are withdrawing from your portfolio and you experience a bad market early in retirement, the damage can be permanent. You are selling shares at depressed prices to fund living expenses. Those shares aren't there to participate in the eventual recovery. Even if the market bounces back, your portfolio might never recover because of the shares you sold at the bottom. Let me give you a concrete example. Imagine 2 retirees, both with $1 million, both withdrawing $50,000 per year. The first retiree experiences 5 good years, followed by 5 bad years. The second experiences 5 bad years, followed by 5 good years. The average return over the 10 years is identical, but the outcomes are dramatically different. The first retiree, who got good returns early, ends up with more money, despite the later bad years. The second retiree, who got bad returns early while taking withdrawals, ends up with much less or even runs out of money. Same average return, completely different outcome. That is sequence of returns risk, and it is why your 60s require a different approach than your 40s. Here is how to avoid this mistake. First, acknowledge that your situation has changed. You are not the same investor you were 20 years ago. Your goals are different, your timeline is different, your strategy should be different too. Second, reduce your equity exposure as you age. The traditional rule of thumb, hold your age in bonds, might be too conservative for some people. But a 65-year-old should probably have no more than 50 to 60% in stocks, with the rest in bonds, cash, and other conservative investments. Third, create a buffer against sequence of returns risk. Hold 1 to 2 years of living expenses in cash or short-term bonds. This allows you to avoid selling stocks during a downturn. You can draw from the buffer while waiting for the market to recover. Fourth, shift your stock allocation toward more defensive positions. Dividend, paying stocks, value stocks, defensive sectors like utilities and consumer staples. These tend to decline less during bear markets, providing some protection when you need it most. Mistake number 3 is letting emotions drive investment decisions. This mistake affects investors of all ages, but it is particularly devastating for people over 60 because you don't have time to recover from emotional mistakes. Human beings are wired for certain emotional responses that served us well on the savannah but serve us poorly in financial markets. When we see danger, we want to flee. When we see opportunity, we want to chase it. These instincts are hardwired into our brains over hundreds of thousands of years of evolution. But in investing, these instincts lead us astray. When markets are crashing, when the news is terrible, when it feels like the world is ending, our instinct is to sell everything and run to safety. But that is almost always exactly the wrong thing to do. Markets crash. Then they recover. The investors who sell at the bottom lock in their losses. The investors who hold on or even buy more participate in the recovery. Similarly, when markets are soaring, when everyone is making money, when it feels like you are missing out, your instinct is to pile in and chase performance. But that is also wrong. Markets that have risen a lot are often overvalued. The easy gains have already been made. Buying after a big run-up often means buying high and then watching your investment decline. I've seen this pattern so many times it makes me want to scream. In 2000, after years of dot-com mania, people who had been skeptical finally capitulated and bought tech stocks at the peak. They couldn't stand watching their neighbors get rich anymore. Then the bubble burst and they lost 60, 70, 80%. In 2008 and 2009, people who had held stocks through years of gains panicked at the bottom. They sold everything and went to cash after the market had already fallen 50%. Then they missed the recovery. They sold low and never bought back. In 2020, the pandemic crashed markets 30% in a month. People panicked and sold. Then the market recovered completely within months and continued to new highs. The people who sold in the panic missed one of the greatest recoveries in market history. Each time, emotions drove decisions. And each time, those emotional decisions destroyed wealth. Here is how to avoid this mistake. First, have a written investment policy statement. Write down your target allocation, your rebalancing rules, and your plan for different scenarios. When emotions are running high, refer back to this document. Let the policy drive decisions, not your gut second. Limit how often you check your portfolio. Daily monitoring encourages emotional reactions. Check monthly or quarterly instead. The daily fluctuations don't matter. What matters is whether you are on track for your long-term goals. Third, have an accountability partner, a spouse, a friend, a financial advisor, someone who can talk you off the ledge when you are about to make an emotional decision. Sometimes just voicing your fear or greed helps you recognize that you are being irrational. Fourth, remember that volatility is normal. Markets decline 20% or more about once every 4 years on average. Declines of 10% happen almost every year. This isn't crisis. This is normal. Expect it. Plan for it. Don't panic when it happens. Fifth, automate what you can. Automatic rebalancing removes emotion from the equation. If your policy says to rebalance when any asset class drifts more than 5% from target, set that up to happen automatically. You won't have to make the emotional decision to sell what has gone up and buy what has gone down. It just happens. Mistake number 4 is ignoring fees and taxes. This might seem like a minor issue compared to the dramatic mistakes I've described. But over a long retirement, fees and taxes can consume an enormous portion of your wealth. Death by 1,000 cuts. Let me show you the math on fees. Suppose you have $500,000 and you are comparing 2 investment options. Option A is a low-cost index fund with an expense ratio of 0.03%. Option B is an actively managed fund with an expense ratio of 1%. The difference is less than 1% per year. How much could it matter over 20 years, assuming 7% annual returns before fees? Option A grows to about $1,900,000. Option B grows to about $1,600,000. That is a difference of $300,000 just from the fee difference. $300,000 that went to fund managers instead of staying in your pocket, and that is just the explicit expense ratio. There are also trading costs within funds, which aren't included in the expense ratio. There are sales loads on some funds, there are 12B1 fees, there are wrap fees. If you use certain financial advisors, there are account fees at some brokerages. All of these nibble away at your returns. I am not saying all fees are bad. Some services are worth paying for. But you need to understand what you are paying and whether you are getting value for those fees. Most actively managed funds underperform their benchmark indexes. You are paying extra for worse performance. That is a terrible deal. Taxes are equally important and equally overlooked. Where you hold investments matters enormously for after-tax returns. Traditional IRAs and 401k plans are tax-deferred. You don't pay taxes on gains until you withdraw. These accounts are ideal for bonds and other investments that generate ordinary income, which is taxed at your highest rate. Sheltering that income saves you significant money over time. Roth IRAs are tax-free. Qualified withdrawals are never taxed. These accounts are ideal for investments with the highest growth potential. If a stock doubles or triples, you keep all the gains tax-free. Taxable brokerage accounts are subject to capital gains taxes. But long-term capital gains rates are lower than ordinary income rates for most people. And there is a step-up in cost basis at death, meaning your heirs won't pay capital gains on appreciation that occurred during your lifetime. Proper asset location, holding the right investments in the right accounts, can add 1/4 to 0.5% per year to your after-tax returns. Over 20 or 30 years, that compounds to a meaningful difference. There is also tax loss harvesting, selling investments at a loss to offset gains and reduce your tax bill. There are qualified charitable distributions from IRAs, which satisfy your required minimum distribution without increasing your taxable income. There are Roth conversion strategies that can reduce lifetime taxes. Here is how to avoid this mistake. First, know what you are paying. Add up all the fees across all your accounts, expense ratios, advisory fees, account fees, everything. If it is more than 1% of your portfolio annually, you are probably paying too much second. Use low-cost index funds and ETFs wherever possible. Vanguard, Schwab, Fidelity, and others offer excellent funds with expense ratios under 0.1%. There is no reason to pay more unless you are getting clear value in return. Third, be thoughtful about asset location. Hold bonds in tax-advantaged accounts. Hold stocks with high growth potential in Roth accounts. Hold tax-efficient investments, like index funds in taxable accounts. Fourth, work with a tax-aware financial advisor or accountant. The strategies for minimizing lifetime taxes can be complex. Professional guidance often pays for itself in tax savings. Mistake number 5 is not having a plan for healthcare costs and longevity. This might be the most underappreciated risk facing people over 60. Healthcare costs can be enormous. Living longer than expected can deplete savings, and the combination of the two can be devastating. Let me give you some numbers. According to various studies, an average couple retiring at 65 might need $300,000 or more to cover healthcare costs in retirement. That is not long-term care. That is just regular healthcare expenses, Medicare premiums, supplemental insurance, prescriptions, out-of-pocket costs. Long-term care is on top of that. The average nursing home costs over $100,000 per year. Assisted living is less, but still substantial. Home health aides cost tens of thousands per year, and these costs are rising faster than general inflation. Medicare doesn't cover long-term care. Many people don't realize this until they need it. They assume Medicare will pay for nursing home care, and then they get a shock when they discover it. It doesn't. Medicaid covers long-term care, but only after you've spent down nearly all your assets. That is not a plan, that is impoverishment. On the longevity side, people consistently underestimate how long they'll live. A 65-year-old man has about a 50% chance of living past 85. A 65-year-old woman has about a 50% chance of living past 87. And these are averages. If you are healthy and have good genes, you might live into your 90s or beyond. Living longer is wonderful, but it requires more money. If you plan for 20 years of retirement and live for 30, where does the extra money come from? If you draw down your portfolio too quickly because you assumed a shorter lifespan, you might find yourself running out of money in your late 80s or 90s. That is a terrifying prospect. Here is how to avoid this mistake. First, budget realistically for healthcare. Don't assume Medicare covers everything. Build healthcare expenses into your retirement budget, including premiums for Medicare Part B, Part D, and supplemental coverage, plus out. Pocket costs. Second, have a plan for long-term care. This might mean long-term care insurance, though. It has become expensive and harder to get. It might mean self-insuring by setting aside assets, specifically for potential care needs. It might mean hybrid life insurance products that include long-term care benefits. It might mean planning to rely on family. Whatever your plan is, have one. Third, plan for a long life. Use life expectancy calculators that account for your specific health and family history. Consider planning to age 95 or even 100 to be safe. It is better to have money left over than to run out. Fourth, consider annuities for a portion of your portfolio. I know annuities have a mixed reputation. There are bad annuities with high fees and complicated terms. But there are also simple, immediate annuities that convert a lump sum into guaranteed income for life. For retirees worried about outliving their money, converting some assets to an annuity provides insurance against longevity risk. Fifth, keep working if you can. I don't mean slaving away at a job you hate, but part-time work, consulting, turning a hobby into income. These can supplement your portfolio in the early years of retirement. The longer you can delay drawing on your portfolio, the more likely it is to last. Let me bring all of this together with some final thoughts on how to protect your wealth after 60. The 5 mistakes I've described: chasing yield, failing to adjust your strategy, letting emotions drive decisions, ignoring fees and taxes, and not planning for healthcare and longevity. They all share a common thread. They're all mistakes of overconfidence or denial. Overconfidence that you can earn higher returns without higher risk. Denial that your situation has changed as you've aged. Overconfidence that you can time the market based on your emotions. Denial about the impact of fees and taxes. Denial about the cost of healthcare and the possibility of living longer than expected. The antidote to these mistakes is humility and planning. Humility to accept that markets are unpredictable. Humility to accept that you are not the same investor you were 20 years ago. Humility to accept that you can't consistently outsmart the market. Planning to prepare for multiple scenarios. Planning to account for costs you might prefer to ignore. Planning for a long life rather than assuming you won't live that long. I've spent my career taking calculated risks. I made $7 billion in a single year by betting aggressively when the odds were in my favor. But I've also spent my career avoiding catastrophic mistakes. The big wins get the headlines, but the avoided losses are what really built my wealth over time. When you are over 60, avoiding mistakes matters more than ever. You don't have time to recover from catastrophic errors. You don't have decades of future earnings to rebuild your savings. What you have is what you have, and your job is to make it last. The 5 mistakes I've shared today will destroy your wealth if you make them. But now that you know what they are, you can avoid them. You can be the person who protects what they've built rather than the person who squanders it. You can be the person who enjoys a secure and dignified retirement rather than the person who runs out of money. That is my goal for everyone watching this. Not to make you rich, not to help you beat the market, just to help you avoid the mistakes that destroy wealth after 60. Because if you can avoid those mistakes, if you can protect what you've accumulated, you'll be just fine. And that is what really matters at this stage of life. Let me go deeper on each of these mistakes, because understanding the psychology behind them helps you recognize when you are about to make them. The yield, chasing mistake comes from a completely understandable place. You've worked hard your whole life. You've saved diligently. Now you are retired or approaching retirement, and you need income. You look at what safe investments pay, and it feels inadequate. You start thinking, maybe I need to take a little more risk to get the income I need. That thinking is the first step down a dangerous path. Because once you start reaching for yield, it is hard to stop. You buy something paying 6%, it works out fine. So you buy something paying 8%, that works out too. So you buy something paying 10%, and eventually your luck runs out. You buy something paying 12% that blows up and costs you years of that extra income in a single loss. The financial industry knows this psychology and exploits it ruthlessly. They create products designed to appeal to yield-hungry retirees, high-yield bond funds, preferred stock funds, covered call funds, closed-end funds trading at discounts, mortgage REITs, business development companies. Each one is marketed based on its attractive yield, with the risks buried in fine print that nobody reads. I am not saying all of these products are bad. Some can play a role in a diversified portfolio. But too many retirees concentrate too much of their wealth in these products because they're seduced by the yield. They don't understand that they're taking equity. Like risk for bond, like returns. They don't understand that a 10% yield means nothing if you lose 30% of your principal. The solution is to start with your spending needs and work backward. Figure out how much income you actually need from your portfolio after Social Security and any pensions. Then figure out how much you can safely withdraw using the 4% rule or similar guidelines. If your safe withdrawal amount covers your spending needs, great. You don't need to reach for yield. If there is a gap, you have three choices: reduce spending, work longer, or accept more risk. But make that choice consciously, with full understanding of the risks, not by sleepwalking into high-yield products. Because they look attractive, the failure to adjust strategy mistake comes from inertia and from identity. Inertia because changing your portfolio takes effort. You have to think about what to sell. You have to deal with taxes on gains. You have to decide what to buy instead. It is much easier to just leave things alone. The portfolio has worked fine so far. Why change it? Identity because your investment approach becomes part of who you are. If you've been an aggressive investor for decades, if you've identified as someone who beats the market through smart stock picking, shifting to a conservative approach feels like admitting defeat. It feels like giving up. It feels like becoming old, but here is the reality. The approach that was smart at 40 is reckless at 65. The circumstances have fundamentally changed. Your time horizon is shorter. Your ability to earn income to replace losses is diminished. Your need for stability and income has increased. Failing to recognize these changes isn't brave or aggressive. It is foolish. I've seen proud investors, people who built their wealth through active stock picking, refuse to change their approach in retirement. They kept running concentrated portfolios with 90% in stocks. They scoffed at bonds and dividend stocks as too conservative. And when the market turned against them, they suffered devastating losses that they couldn't recover from. Their pride became their downfall. The solution is to separate your identity from your investment approach. Your worth as a person isn't tied to your portfolio returns. Shifting to a more conservative approach in retirement isn't defeat. It is wisdom. It is recognizing that different stages of life require different strategies. The goal in retirement isn't to beat the market. The goal is to maintain your lifestyle without running out of money. Those are very different objectives, requiring very different approaches. The emotional decision, making mistake, is the hardest to overcome because it is rooted in our evolutionary psychology. Our ancestors survived because they responded quickly to threats. The ones who saw a predator and ran away lived to reproduce. The ones who stopped to analyze the situation became lunch. Those survival instincts serve us poorly in financial markets. When the market crashes, our ancient brain screams, "Danger, run away." It interprets the falling portfolio balance as a threat to survival, which in some sense it is, and it demands immediate action to escape the threat. But the action it demands, selling everything and fleeing to safety, is exactly wrong. By the time you are panicking, the worst of the damage has already happened. Selling at the bottom locks in losses. Missing the recovery makes it worse. The emotional response that would have saved you from a predator destroys your wealth in markets. The same dynamic works in reverse during euphoria. When markets are soaring, when everyone is getting rich, our brain interprets staying out as a missed opportunity. It demands action to capture the gains before they disappear. Fear of missing out is a powerful motivator. But the action it demands, buying after a big run-up, is also wrong. By the time you are feeling euphoric, the easy gains have been made. Valuations are stretched. The risk-reward has shifted unfavorably. Buying into euphoria often means buying high before the inevitable correction. The solution requires recognizing that your instincts are unreliable in financial markets. When you feel strong emotions about your portfolio, that is a signal to slow down, not to act quickly. The stronger the emotion, the more likely you are about to make a mistake. Develop rules that force you to act against your instincts. When markets are crashing and you want to sell, your rule might be to buy instead through rebalancing. When markets are soaring and you want to buy more, your rule might be to trim positions back to target weights. Let the rules override your emotions. The fees and taxes mistake is insidious because each individual fee seems small. A 1% advisory fee, a 0.5% expense ratio, a few $1,000s in unnecessary taxes. Each one seems insignificant in isolation, but they compound over time into staggering amounts. Let me give you another way to think about fees. If your portfolio returns 7% per year and you pay 2% in total fees, you are keeping 5%. If your neighbor's portfolio also returns 7%, but they pay only 0.5% in fees, they're keeping 6.5%. Your neighbor's effective return is 30% higher than yours. Over 20 years, that difference compounds into hundreds of thousands of dollars. The financial industry loves to minimize the impact of fees. They'll tell you that paying 1% for professional management is worth it for the peace of mind. They'll tell you that actively managed funds justify their higher fees through better returns. They'll tell you that their advice is worth every penny. Some of that might be true in specific cases, but the overwhelming evidence shows that most actively managed funds underperform their benchmarks after fees. Most financial advisors don't add value beyond what you could achieve with a simple portfolio of index funds. Most fees are wealth transfers from your pocket to the financial industry's pocket with no benefit to you. Taxes are similar. Most people don't think carefully about asset location, which accounts to hold which investments in. They don't harvest tax losses systematically. They don't plan withdrawals to minimize taxes. They don't use strategies like qualified charitable distributions or Roth conversions. Each missed opportunity seems small, but they add up. The solution starts with awareness. Know exactly what you are paying in fees across all your accounts. Calculate the total annual cost as a percentage of your portfolio. If it is above 1%, look hard at what you are getting for that cost. Consider whether you could achieve similar results at lower cost. On taxes, educate yourself, or work with a tax. Aware advisor, the strategies aren't that complicated once you understand them. Asset location, putting bonds in tax, deferred accounts, and stocks in taxable accounts, is straightforward. Tax loss harvesting requires some attention but isn't difficult. Roth conversion strategies take some analysis but can save significant money. The healthcare and longevity mistake comes from denial. Nobody wants to think about getting sick. Nobody wants to think about needing long-term care. Nobody wants to think about death, so people avoid planning for these certainties. They assume they'll be healthy. They assume Medicare covers everything. They assume they won't live that long. But the statistics are unforgiving. Most people will face significant healthcare costs in retirement. Many will need some form of long-term care, and many will live longer than they expect, requiring their money to last longer than they planned. I've seen families devastated by long-term care costs they didn't anticipate. The healthy spouse watches the savings drain away, paying for the sick spouse's care. By the time the sick spouse passes, there is nothing left. The surviving spouse faces poverty. It is heartbreaking and entirely preventable with proper planning. The solution requires confronting unpleasant possibilities. Sit down with your spouse and talk about what happens if one of you needs long-term care. Research the costs in your area: nursing homes, assisted living, home health aides. Understand what Medicare covers and what it doesn't. Then make a plan. Maybe you buy long-term care insurance, though it is expensive and increasingly hard to get. Maybe you self-insure by earmarking specific assets for potential care needs. Maybe you purchase a hybrid life insurance policy with long-term care benefits. Maybe you plan to rely on family, though that is a lot to ask of your children. On longevity, run the numbers for a long life. What if you live to 95 to 100? Does your plan still work? If not, what adjustments do you need to make? Maybe you need to save more before retirement. Maybe you need to reduce spending in retirement. Maybe you need to work longer. But make those adjustments while you can, not when you are 85 and running out of money. Let me share some final thoughts on how to implement what I've taught you today. First, do a complete audit of your current situation. What is your asset allocation? What are you paying in fees? How are your investments distributed across account types? What is your plan for healthcare and long-term care? What is your withdrawal strategy? Be honest with yourself about where you stand. Second, identify the gaps and risks. Are you chasing yield without understanding the risks? Is your allocation appropriate for your age? Are you making emotional decisions? Are you paying too much in fees or taxes? Do you have a plan for healthcare costs and longevity? Third, make a plan to address the gaps. This might mean rebalancing your portfolio. It might mean switching to lower-cost investments. It might mean developing rules to prevent emotional decisions. It might mean purchasing long-term care insurance. Whatever the gaps are, have a specific plan to address them. Fourth, get help if you need it. I've given you the framework, but implementation can be complex. A fee. Only Fiduciary Financial Advisor can help you develop and execute a comprehensive plan. A tax professional can help you minimize taxes. An estate planning attorney can help you plan for healthcare decisions and wealth transfer. These professionals cost money, but good ones pay for themselves many times over. Fifth, review regularly. Your situation changes over time. Your portfolio drifts from target allocations. Tax laws change, healthcare costs change. Review your plan at least annually. Make adjustments as needed. Stay on top of things. The 5 mistakes I've described today: chasing yield, failing to adjust strategy, emotional decision, ignoring fees and taxes, and not planning for healthcare and longevity, have destroyed the wealth of countless people over 60. But you don't have to be one of them. You now know what these mistakes are. You know how to recognize them. You know how to avoid them. The choice is yours. You can ignore this warning and continue doing what you've always done. Maybe you'll be fine, or maybe you'll make one of these mistakes and destroy your wealth. Or you can take this seriously, you can audit your situation, you can make changes where needed, you can protect what you've spent a lifetime building. I know which choice I'd make, and I hope you make the same one. Because after everything you've worked for, you deserve a secure and comfortable retirement. You deserve to enjoy the fruits of your labor without financial anxiety. You deserve to leave a legacy to your family rather than running out of money. That is within your reach. Just avoid these 5 mistakes, and you'll be fine.